On March 27, 1980, silver fell from $21.62 an ounce to $10.80 in a single trading session. The market named the date Silver Thursday. At the brokerage, Bache, Halsey, Stewart Shields, a margin clerk tallied a hunt account that could not meet a call of roughly $135 million. The firm's own solvency now depended on money it did not have. This episode does not answer why two brothers bought silver. It answers how a leveraged position built on borrowed money and physical delivery can look for a time like a bull market, then reveal itself as a single obligation no counterparty could survive. Begin with the instrument. The mechanism at the center of this case is the commodity futures contract, traded on margin, combined with physical accumulation of the underlying metal. A futures contract is a standardized agreement to buy or sell a commodity at a set price on a future date. To hold one, a trader posts margin. That margin is a fraction of the contract's full value, typically 5 to 10% in this period. This is the legitimate function of margin. It lets producers and consumers hedge price risk without tying up the full cash value of the goods. A rancher locks in a price for cattle. A jeweler locks in a price for silver. The exchange stands between them, and the margin absorbs daily price swings through a process called marking to market. Margin also creates leverage. A trader who posts 10% controls 10 times his capital. If the price rises, gains accrue on the full contract value, not on the margin posted. If it falls, losses accrue the same way, and the exchange issues a margin call demanding additional funds to restore the required cushion. Now, the second element. A futures contract can be settled in cash or by physical delivery. Most speculators roll their contracts forward and never take delivery. A trader who systematically demands delivery removes physical metal from the deliverable supply. Remove enough metal while long positions accumulate, and the shorts who owe delivery cannot source the metal to settle. This is the classic structure of a corner. The hunt accumulation combined both leveraged futures positions and demands for physical silver, held partly through foreign accounts and a jointly owned Bermuda entity. Now, the architecture. Nelson Bunker Hunt and William Herbert Hunt began accumulating silver in the early 1970s. By late 1979 and into 1980, the position had grown to a scale the market had not previously absorbed. The public record developed by the CFTC and the SEC, later litigated in the civil suit brought by Minpeco, shows the Hunts and associated parties controlled or influenced positions and physical holdings amounting to a very large fraction of the deliverable silver supply outside government stocks. Step 1. Accumulation of futures long positions on the Commodity Exchange, COMEX, and the Chicago Board of Trade, held through multiple accounts at multiple brokers. Distributing the position across accounts and brokers reduced the visibility of its true concentration to any single counterparty. Step 2. Demand for physical delivery rather than cash settlement. As contracts matured, the Hunts took delivery of bullion, some of it transported to Switzerland. Each delivery converted a paper position into physical metal, removed from the exchange deliverable pool. Step 3. Allied capital. In 1979, the Hunts entered arrangements with wealthy Saudi and other international investors and formed International Metals Investment Company, a Bermuda entity, to hold silver positions jointly. This expanded the buying power behind the position beyond the brothers' own balance sheet. Step 4 is the structural core. The position was self-reinforcing on the way up. As physical silver was withdrawn and long positions grew, the price rose. Silver went from around $6 an ounce in early 1979 to a peak near $50 in January 1980. Rising prices increased the mark-to-market value of the existing long positions. That increased equity could be pledged or used to support additional purchases. The position financed its own expansion. Unrealized gains on leveraged contracts became the collateral for the next layer. The entire edifice rested on the price continuing to rise, or at minimum, not falling. The leverage that amplified gains on the way up would, on any reversal, amplify losses and generate margin calls in exact proportion. The position had no natural exit. To sell into a market they themselves dominated would collapse the price they were selling into. The metal could not be liquidated without destroying the value of the paper, and the paper could not be held without continuous cash to meet marks. The Hunts financed much of this through bank borrowing, pledging silver and securities as collateral. Estimates developed in litigation placed the borrowings well over $1 billion across a syndicate of banks. Consider what this produces. A long futures position financed by bank debt, collateralized by silver, whose price is held up by their same position. Three markets are now bound into one obligation: the futures market, the physical bullion market, and the credit extended by the banks and brokers. A move in any one transmits directly to the others. The org chart is not complicated. It is a loop. The gatekeepers did not intervene sooner. The verification chain ran through three institutions: the exchanges, the federal regulator, and the brokers extending credit. The exchanges saw the position concentration through their own clearing data. But the position was spread across accounts and across the two principal exchanges, COMEX and the CBOT, which did not fully aggregate their surveillance. The Hunts also held positions offshore and through the Bermuda entity, outside direct US exchange reporting for portions of the accumulation. Concentration that is legible only in fragments does not trigger the alarm the same concentration would trigger if seen whole. The CFTC was a young agency established in 1974. It had authority over position limits and could set them. Silver futures in this period were not subject to speculative position limits at the levels that would have constrained the Hunts early. The agency's tools were reactive. The brokers extending margin credit faced a specific structural conflict. A broker earns commissions and interest on a large account. As the Hunt position grew and its paper value rose, the account appeared well capitalized on a mark-to-market basis. The collateral looked ample, precisely because the price was inflated by the position the collateral supported. Earlier detection required one thing: a single supervisor would have needed to see the aggregate position across all brokers, all exchanges, and the offshore accounts at once, and to value the collateral not at market, but at a liquidation price that accounted for the fact that the holder could not sell without crashing the market. No one held that consolidated view. The accounting convention of marking to current market price actively concealed the liquidation risk. The intervention came from the exchanges themselves. It reversed the loop. In January 1980, COMEX and the CBOT imposed restrictions. They raised margin requirements sharply and, critically, adopted rules limiting positions and permitting liquidation-only trading. Under liquidation-only, a trader could close positions but not open new ones. This removed the buyer of last resort from the market. The self-reinforcing loop ran in reverse. The unraveling followed the mechanism precisely. New buying was choked off and margins raised. The price stopped rising. As it fell, the mark-to-market value of the hunt positions declined. Declining value triggered margin calls. Meeting margin calls required cash. Raising cash required selling silver or borrowing more. Selling silver into a falling, thinning market drove the price down further, which triggered further margin calls. Each turn of the loop demanded more cash and produced less. On March 25th and into March 26, 1980, the hunts informed their brokers, including Bache, that they could not meet a margin call. The record establishes that Bache, holding a large hunt position, faced the prospect that its client's default would exceed the firm's own capital. On March 27th, Silver Thursday, the price collapsed by roughly half in one session. The market had absorbed the reality that the largest holder was a forced seller with no capacity to defend the price. Bache began liquidating hunt collateral. The firm's survival and the stability of the brokers and banks in the chain became a matter of federal concern. The resolution was a bank rescue. A syndicate of banks extended a loan of approximately $1.1 billion to a hunt partnership, structured to allow an orderly workout of the silver position rather than a fire sale default that would have propagated through the brokerage system. The Federal Reserve did not lend directly. It signaled that credit for orderly liquidation was acceptable while discouraging further speculative silver lending. The public record closed through multiple channels. The CFTC and civil litigation, notably the Minpeco suit, produced findings that the Hunts and their associates had acted to manipulate the silver market. A jury, in that case, found against them. The brothers later filed for bankruptcy under the weight of the debts and judgments. The record establishes not merely a losing trade but a manipulation, adjudicated as such. What the case establishes structurally is this: a leveraged position that suppresses its own deliverable supply generates a price that is not a market price. It is a function of the position itself. Mark-to-market accounting values such a position at a number that cannot be realized, because realization destroys the number. The collateral and the obligation are the same object viewed from two sides. Detection failed for two reasons. Surveillance was fragmented across exchanges, agencies, and brokers, and the prevailing valuation convention measured current price rather than liquidation price. The direct consequences were regulatory. The exchanges and the CFTC moved toward firmer speculative position limits and coordinated cross-market surveillance. Margin authority became a live instrument of market control rather than a static requirement. The finding of the case is not about two men. It is that leverage and physical concentration, combined, produce a price that is collateral for its own destruction.